Welcome everyone. Got a lot of questions on our homework from deferred taxes, and I don't blame you. It is a complicated process, and so I want to make this podcast to perhaps explain the spreadsheet that gives the answers, and we can hopefully take a little extra time here to make sure that we can understand this a little better. This was problem one, is a continuation from the exercises we did earlier, and because the information is given in a little different format, we're going to I want to illustrate the tax return and the income statement side by side. So in this case, instead of starting with an actual number on the income statement, we have two pieces of information. We know that everything that's the same on the tax return on the income statement adds up to $462,000 of income. So to that point, both the tax return and the income statement are the same. Then we can start looking at the differences. I think that might help us see this a little better than just doing the tax return and the differences. So first of all, we know that the tax return has municipal interest needs to be subtracted, that's not taxable. But we don't make any change on the income statement, okay? Because that municipal interest is already included in that regard. And then life insurance, just the opposite, that is going to be added back because it's not deductible and no effect on the income statement. Those are two permanent differences. So I think part of the concern or confusion is this starting point, which things are included already when we start, and that has to do with how clearly we indicate. And in real life, you would have all this data in front of you and be able to determine what was different from the tax return and the income statement. So once we've identified those, and again, I don't want you, because every situation in real life will be a little differently as to how it's laid out, as to what is included and what is not included when we start here. But in this case, we're going to make the assumption that those two are not included on the need to be just on their tax return, but on the income statement, permanent differences. So we know those aren't our biggest concern. Those are the easy part. Then we get to bad debts, and we use our allowance for bad debts T account over here. We notice that are different than earlier, the examples. The allowance, here's the increase, the estimated amount. Here is the write-offs. And in this case, the write-offs are actually higher than what we can take as our allowance. So you see the difference. What we do on the tax return is different than what we do on the income statement. And again, we're assuming that none of that bad debts, because it's different, was included in this original number. All right, unearned revenue, we also, in this case, unearned rent, also has a T account, and we'll see that it brought over $11,000 from the year before, but this year there was $26,500, but on the income statement we would have recorded the $11 that was actually earned from last year. So that's why we have two different numbers, one on the income statement, one on the tax return. So if you were looking at just the differences, you would only worry about the $15,500 and the difference between these two. On depreciation, we have a little schedule over here that says our depreciation for the year for tax purposes, $53.78. You'll see the formula up here using to use makers. And then we have the two assets, both on our books, going over the straight line over the course of their lifetime, and that total is 10. So in this case, you have again a difference that's different than what we've encountered in the examples because income statement depreciation is actually higher than the tax return depreciation. So that seems backwards because that's what happens. This is what we call our differences reversing. They actually go back the other way because at some point depreciation total has to be exactly the same on the tax and our financial statements over time. So the problem asks to calculate taxable income. So if we assume all of these needed to be adjusted to get our taxable income because they were not included in our 462,000, then this is our taxable income as stated. This would be what our income statement would look like at that point, income before taxes with these things included. Now, here's our tax expense current because all we do is take the taxable income, multiply by the tax rate, and we of course credit taxes payable. Now, for the allowance, our cumulative difference, and remember that's what we want to do to make our adjusting entries, is look at the cumulative difference, is the allowance at the end of the year. So we look at the allowance in our T account and it's 22,625. Multiply that by the tax rate to get 7919. We compare that to last year, all right, which is on another sheet, but we compare it and we get a difference of 901, and we're actually going to reduce our deferred tax asset because our allowance actually went down. If you look at our T account, allowance went from 25.2 to 22.625. So that means that the asset, tax asset associated with that, is also going to go down. And so we need to debit the expense and credit the asset. Okay. Under unearned revenue, our cumulative, as you see here on the T account, is 26.5. Okay. Future deductible amount, or future, because this is, we're going to pay taxes on it now and not have to pay later, so a future amount that's going to not be taxable is 26.5 multiplied by the tax rate 92.75. Compare that to what we had last year, and the difference is we need to increase our deferred tax asset because the deferred tax asset is based on 11. It's 26.5 versus 11, so you see it went up. And so the deferred tax asset is going to go up that's associated with it. All right, so by 54.25. And then finally, the more complicated one is the depreciation. And I have that schedule where we look at the cumulative difference. This was the difference for just the 1 year. This is the cumulative difference that I calculated over here between cumulative depreciation for the year, for all of the years so far, and the cumulative difference on our books. And so our cumulative difference is 31,084. So we have a tax liability that should be 10,880. And when we multiply by the tax rate, we are going to actually reduce the tax liability and credit the expense because that liability is actually lower than it was last year because our cumulative difference is lower because we're actually catching up. Okay? So this number here that we calculated as our income before taxes is 438,222. The tax expense is the amount we recorded here, tax expense, plus what we recorded here, minus what we recorded here, minus what we recorded here. So that's always a cumulative of multiple journal entries that are adjusting that tax expense. Okay? Now this is the current part, and the other ones are deferred, but most companies do not tell the difference. Subtract that, get our net income. Your effective tax rate is your tax expense divided by your income before taxes. And then we have our two permanent differences that make up the difference between our effective tax rate, just under 34%, and our statutory tax rate of 35%. All right. So when this happens the next year, we have a large loss. We're going to do a similar thing. Start with 1150. We took out all of the permanent differences to make our life a little simpler. We noticed that the bad debt situation has changed some, gotten much worse as far as total dollar amounts. As far as estimate here, actual write-offs here, just like it shows in the T account. Okay, and then we still have depreciation carrying over for 2019. We have our calculation of depreciation, and for books it's the same as last year, right? Because it's nice and straight line, and the cumulative total for the last 4 years, and the 4 years. Whoops, get over a little further. There we go. You can see those numbers. All right, and then so that's your taxable income, or in this case, net operating loss. This is what the income statement would show, because you see the difference between the two. Refund receivable is the amount of this NOL carried back to 2 years ago to get back all the taxes we paid in 2017. No, 2 years before in exercise 2, and then all of the taxes we paid last year, 154, which you see right up there, and we're only worried about the taxes that were payable, actual current taxes. That's all that counts. Okay, that does not, neither of those loses up all of the NOL, because we wipe out the income for those years and still have some left to carry forward. And so then the rest of it, you see right here, is the NOL left, is then going to be multiplied by the tax rate to get our deferred tax asset. So these refund receivables are pretty confident we're going to get that, but they're just deferred tax asset with a company that has lost that much money. It only can be beneficial if there's income in the future, and there's some doubt about that given that large NOL. So there should be maybe consideration of a valuation allowance to indicate that we might not get all of this asset. All right. So the same idea as before. We look at the cumulative difference for the allowance, which of course is the ending balance in the allowance account, deferred tax asset associated with that, and then compare it to the year before. And the difference that we need to record is 2053. Depreciation, our cumulative difference, and I showed you that over here on our little schedule. 24,703 is the cumulative difference in depreciation, and then that tax liability is 8646. Debit the tax liability and credit tax benefit, or tax expense, whatever you want to call it. Usually if it's benefit, since everything is going to be lowering the taxes on this one, we use the term tax benefit, but tax expense is just fine. Negative tax expense is referred to as a tax benefit. All right, so our loss before taxes, the 1207, 718, tax benefit, again adding up all of these numbers, all right, this number, that number, that number, that number, all add up to 422, get our net loss of 785. So these tax benefit actually makes it not hurt as bad as the loss we see up here. And then because there were no permanent differences, there's no need to reconcile our effective tax rate to the statutory tax rate.